We are now joined by Sanjay Mookim, India Equity Strategist with Bank of America Merrill Lynch. He's joining us from Mumbai. Thank you, Sanjay, for speaking with us at NDTV Profit. How do you view the Indian markets? The Nifty is hovering around the 8,400 level. What's the strategy you're deploying for this year?
We are relatively constructive on the Indian market. And one of the starting points that we like was the fact that markets had corrected in line with the EM correction that we saw late part of December. There is obviously a lot of uncertainty on earnings, but that does not preclude returns. In fact, the flows from domestic investors should remain very strong. And there are pockets of the economy which should be able to deliver profit growth on a YOY basis. So we have said to our investors that equity should deliver positive returns in 2017. Our year-end target of 29,000 does imply that. Of course, we all understand that with the demonetization and GST coming through, earnings are more uncertain, and perhaps the risk associated with that is slightly higher this year.
All right. So you're expecting the markets to give positive returns. Where do you think we'll see maximum outperformance? Which sectors are you overweight on?
See, our philosophy is to look at sectors where earnings or profits are likely to grow. There are, 4 or 5 large profit pools in the Indian equity market. We think banks are more likely to deliver a large chunk of profits because of arithmetic. Very simply, there is a low base coming out of last year. Banks were booking very large provisions, as we all understand. And even if there is some weakness in loan growth or some pressure in margins this year, any reduction in provisions should very likely outweigh that. And banks should begin to deliver profits or improving profits through the calendar year, which is why that is one of our biggest overweight positions now. And historically, if you go back to how the economy moves up and down and how stocks perform in line with economic cycles, then banks tend to be coincident or representative of any economic recovery as well. So if you are looking at the demonetization as a bit of a break or a halt in the economic cycle, any recovery should also put you in the corner of banks per se.
But on what premise are you seeing provisioning lower? Do you think the NPA cycle is bottom? Because the impact of demonetization is economic disruption, and there is an expectation there could be an increase in NPAs despite the forbearance that the RBI has given. Plus, we also are looking at implementation of GST, which could be further disruptive. In such a scenario, do you think the NPA cycle is bottomed?
Yes, look, there is cause for worry that SME-related NPAs may potentially increase because of the weakness that we have seen in the economy just now. However, large corporate-related gross NPA additions have already peaked. We track this on a quarter-to-quarter basis. The June quarter was the high in terms of total system NPA additions. And if the NPA additions have peaked, hopefully, with a lag, provisioning costs will also start to fall at banks. We are already starting to see that the YOY declines at the whole banking sector reported for the September quarter at least have started to fall meaningfully. And there is reasonable hope that some of the large banks will not be required to book as many costs going forward. Yes, there is uncertainty, but the arithmetic suggests that the total profit pool for banks should start to improve in a few quarters of time. And that should underpin total growth for banks in the country, which drives equities up.
Would then PSU banks benefit more than private sector banks, just on the basis of valuations?
Well, there is the valuation argument, but there is also the distinction between profit growth and EPS growth. And in many public sector banks, you may perhaps get the first, but not get the latter. And therefore, our preference is for banks where you are unlikely to see much dilution, and which would be the large, let's say, private sector banks or even the large PSUs. But the theme is to stay with banks where dilution risks are lower.
Right. So banks is a space that you like. Which are the other sectors that you're overweight on?
Okay. So let me talk about, where we think the economy is heading, and that might explain why we are overweight. there is a lot of uncertainty related to demonetization, but we warn or we advise investors not to go by anecdotes. I mean, India is a very large and diverse country, and you cannot simplify the impact of a measure such as demonetization into distinct numbers. So it is not fair to say that sales have fallen X% or tariffs somewhere have fallen Y%. If the Central Statistical Organization cannot come to a conclusion with all its resources, I mean, us meeting a few investor corporates, doing rural trips, etc., is not going to solve the problem for us. And therefore, it will have to be very bottom up. We will have to keep tracking where the recovery and the growth is coming from. At the moment, our hope is that being essential consumption and supported by government policy measures, staples should recover faster and more than other consumption in the country. So we are overweight staples in our portfolio. And again, on the theme that government policy measures in reaction to the weakness that we've seen should be supportive, we like cement as well.
Okay, cement and staples. What about consumption? You're expecting the government to be coming out with measures that be supportive for those affected by demonetization. There is also belief that there will be a package coming in for rural India in the budget. So how do you view consumption names?
Right, so that's what I meant. If you look at the potential for policy in the budget, their constraints are, of course, the amount of money they have.
Sanjay, you were talking about the consumption theme. You spoke about cement, and it is also seen as a consumption play. But what I really meant was, would you look at the agro-related consumption stories, be it home improvement, be it seeds companies? How do you view all of this?
Well, these are smaller sectors that, could benefit from the fact that at least, let's say, home improvement sort of spaces where lower interest rates might eventually lead to some sort of recovery. But honestly, the answer right now would be that we don't know. There is an impact on consumer behavior because people have, stood in lines for cash. People have, at least some segments have seen a loss of income as well. And anticipating consumer behavior is going to be very tricky. So our suggestion is that you wait for the numbers to come out. You try and stay on top of the retail sales trends in the country. And should we see an improvement in sales or momentum leaving the final shop door, then we should start getting more comfortable about discretionary sort of names in the country. But you could take a position that staples will more likely recover because, like I said, it is essential consumption and that government policy is more likely to be directed towards that part of the market.
Sanjay, this is Pankaj also joining in the conversation. Just wanted to understand when you say that, banks is something that you like or consumer staple is something that you like, at least in the near term, you believe that there is excessive pessimism and that's why, a reaction like you saw to IndusInd Bank once the numbers came out, a relief is possible if the numbers are decent for any of these sector names?
We have been suggesting that people should not get caught up in the politics of discussion of demonetization. There is another point to make that demonetization or the impact on earnings is not the only variable that will drive equity prices. Prices in India are also driven by valuations and perceptions around that. And that for the last several years has actually been linked to what is happening to the emerging market asset class globally. So from November 8, for a brief while, we've seen adverse impact of an EM contraction and the uncertainty around demonetization, which led to the correction in stock prices. However, what we are seeing now is EMs, which is leading Indian stock prices up, irrespective of the concerns on the Indian economy. So investors need to be aware that there are two variables which matter. And even if we have uncertainty on earnings in the near term, if the EM asset class continues to do well, then India will go up nonetheless. In that respect, the large cap sector such as banks should be in a position to lead the recovery.
Right. For EMs, whenever we talk about flows, there is always a risk premium that is attached and very difficult to say what the risk premium will be. But the statements that you're getting from US, the sort of policies that they are likely to do you believe that risk premium for the entire emerging market basket will go up?
Well, it is very difficult to pinpoint whether and to what extent that will happen. The one thing that you can be relatively confident of is that volatility will be higher. And whether that volatility eventually does translate to an expanded risk premium, we'll see. I mean, there is a lot of evidence to suggest, empirical exercises conducted across the board, that equity risk premiums have not really come down across the world, even though markets have gone up a lot, and that a large part of the expansion in multiples was driven instead by the lower fixed income rates or lower bond yields as such. So it doesn't appear that equity premiums went down in the first place. Whether they go up now in response to some increase in volatility remains to be seen, really.
If the rates in India continue to go down or remain where they are with a marginal negative bias, you think flows would incrementally only come to equity as an asset class?
From a domestic perspective, the answer is I think, a yes, because fixed income post-tax returns are very meager now. Other asset classes such as gold or real estate aren't looking very promising, at least in the next few quarters. And whatever pool of savings is generated in India year after year, incrementally will have to look at equity as an asset class to generate some sort of return. Falling rates is good for bond inflows for a while, but if the market were to decide that we've probably hit a bottom on Indian rates, then bond inflows could wither as well.
Right. In your strategy report, you say that we've been speaking to a lot of strategists, and they say that FY18 would not see a meaningful downgrade to the earnings. But you are of the view that FY18 earnings are optimistic, and FY19 is actually when you see a recovery. Even with these rate cuts, if there is a stimulus which comes into the budget, FY18 numbers seem to be slightly on the higher side?
Yes, we've said as much. Consensus, if I remember my numbers right, is somewhere around 17 to 18% currently for FY18. We think that's probably likely to end in the much lower 11, 12 odd % ranges, because we still see some sort of a froth or hope built into forecasts. It also means that policy action translates into earnings or economic activity only with a lag. And that's why we argue that much of the weakness that we're seeing now will probably persist for a few quarters. But going into a slightly longer horizon, there is reasonable chance of a recovery. If you were to step back and look at economic cycles in the country, the up cycle is generally driven by capital formation. Consumption in India is relatively steady, grows at about 6 to 7% a year. Capital formation is what drives the acceleration in economic growth, if any. That needs to come from real estate formation. It will not come from corporates, because corporates lag the recovery. It will not come from government, because government will need to spend a lot of money to make an impact. But a real estate cycle needs to start for an economic acceleration. And with the demonetization, with the changes in regulation, you actually do not see a real estate cycle improving, at least in the next 3-4 quarters, which is why we're saying that the hope of improvement is perhaps more back-ended than FY18.
Right, and that's why returns may also be back-ended in this year, or maybe towards the start of 2018?
Well, the argument, Pankaj, there is that equities tend to look at 1 year forward earnings. So by the time you are in December 17, and if there is some initial sign or some visibility that growth is recovering, then the market should be willing to discount that slightly ahead of time.
Sanjay, you've upgraded L&T today, and not commenting about the stock, but if you could just tell us what is your view on private capex? You think domestic story would start to recover now? It's been 6-7 years that investors have been waiting for it.
Yes, look, we are not very hopeful that corporate capex will revive in a hurry. That is linked to utilizations of industry in general, and yes, utilizations are going up, but they are perhaps not yet at a stage where corporates as a basket may feel comfortable about big expenditure. There are certain pockets in certain parts of the country where we sense that utilizations may be close to 90 odd % and some capex can start. But as an aggregate, we think corporate India is unlikely to pick up the mantle of expenditure just yet. There are some pockets where the government is spending a lot of money, but the government is also constrained by the availability of money and the shovel readiness of projects.
Thank you so much for taking out time for us. Always a pleasure.